Hi, I'm Pete Andresen with Andresen & Associates, and after last week's video where I discussed the carnage in the bond market, it really, the past year or so has really been terrible for the bond market because of interest rate risk, because of interest rates going up. Now the bond market is down. And what should we do in the bond market right now? Well, I have 5 comments, and you'll see them if you're a client of Andresen & Associates, filtering through your portfolio's performance as time goes on, because these 5 actions are deeply on my mind. Now, the other thing I want to point out is that I don't have a crystal ball here. I don't really know what's going to happen with interest rates, but what history tells us is that when we get a bond market decline like this, it's usually followed by turbulence in the stock market, although this may be the first soft landing in history, in modern history. It's usually followed by a stock market upheaval of some sort. And again, I tend to operate on the theory of what usually happens tends to actually happen. And sometimes that's wrong, of course. The other thing that happens is that bond markets correct. They actually, after they have a period where they go down, they tend to recover. The bond market just got really interesting. It's now a place where you can actually go make money as opposed to a place where you put money so that you won't lose it in the stock market. The past decade has been a decade of pretty much nothingness, even mild negative returns. And now that's changed. Now you can put money in things like 3 months Treasuries and get returns. But let's get to the top 5 things that I'm doing right now. The first thing that I'm doing is I'm taking tax losses. You can't do that in retirement plans or IRA accounts, but where appropriate and where sensible, in your taxable accounts, reasonable, careful, mindful tax loss actions are very appropriate here because you have genuine losses. You've got real losses in some of those bond mutual funds and some of those actual bonds if you hold individual bonds. So the first step is mindfully, carefully, thoughtfully take tax losses where you can. The second thing is that the gigantic low-hanging fruit in this situation right now, just mind-bogglingly attractive, is to take advantage of short-term Treasuries right now. They are offering tremendous yields, and up to 5 something on the 6-month side right now. These won't last because what's going to happen is the bond market is going to correct in some way, and the yield curve, one way or the other, is either going to have the far end rise or the short end drop. Usually the short end drops, and so right now is this golden moment to take advantage of short-term Treasuries, individual bonds. The third thing I would do, that I'm doing, is, and you've seen it if you're my client, is to gradually, slightly move out on the yield curve. That means your average maturity of your bonds gets longer, and what that means is that we didn't take a lot of losses. We took some shocking losses from the standpoint of short-term bonds. They're ugly, but they weren't catastrophic like the longer-term bonds were. So those losses allow us, and the preserved capital allow us to buy some of the bonds that did lose a lot more money that are cheaper right now. So we're mildly moving maturities out, and you'll see that. Is it right? Well, if we really knew that the interest rate was going to drop, we'd buy 30-year Treasuries, but that's a bit reckless because we don't really know what's going to happen. So look for a gradual move. Look for a lesser move. Okay, that fourth thing that I'm doing right now is I am considering and investigating bond alternatives like preferreds, utility stocks, and convertibles. Again, those things were very fully priced. Again, a lot of them are down dramatically, and they may be bargains. So this is more something that's going to unfold in the next couple of months. Another way to do this is to access your asset allocation funds, which have a good position in bonds. FPA Crescent, Vanguard Wellesley, Vanguard Wellington, Dodge and Cox Balanced Fund. All these have an allocation to bonds, and all of them, all those mutual funds have proven that they have been very astute. Are they going to be astute in the future? Absolutely no guarantees. But in the past, they've been able to manage a situation like this very, very nicely. Now, the fifth thing is something I'm not doing. I am not buying high-risk bonds right now. Why? Because although the data does suggest that a soft landing is inevitable, the first one in modern history, after a Fed interest rate raise like this, a recession is still historically likely. And if a recession happens, high-yield bonds tend to act like stocks. They tend to drop like rocks. The time to buy high-yield bonds then is after a stock market hit happens, after we go into a recession, not when there's a potential of a credit crunch emerging, as there is now. So the fifth thing I'm doing, I'm not buying high-yield bonds right now. So 1, tax losses. 2, Treasury bills. 3, extend the yield curve, extend out on the yield curve slightly. 4, consider bond alternatives. 5, I'm not buying high yield bonds. Is this all going to happen? Probably not, but a great deal of it is. And my expectation is that the most likely thing is probably what's going to happen. And with that probability in mind, those are the steps I'm taking. Call me if you have any questions. Meanwhile, enjoy September. We're having it's a good month so far. Take care of yourselves, and blessings.